everybody in Australia, and a good morning for those of you joining us from China. Thank you for logging into today's session. I'm Lucy Du, Belz Family and Associates Head of Business Development. For those of you joining our webinar for the first time, a big warm welcome. Belz Family is an investment management firm that focuses on cross-border opportunities between Australia and China. What makes us unique is that we leverage family office intelligence and our investor and advisory networks to provide a holistic, values-driven approach to building wealth and knowledge. Our team works on the principles of trust, integrity, and transparency to foster long-term relationships between Australian and Chinese family offices and sophisticated investors through collaboration and partnerships. And our mission is to build and grow a trusted community of Chinese and Australian family offices, sophisticated investors and their advisors, and provide exclusive opportunities to collaborate, invest, and learn from one another. It's been a few months since we last connected in this format, and since then, I'm sure you all know a lot has happened. In Australia, our economy's recovery from COVID-19 has been slightly delayed by the measures taken in Victoria to address the outbreak. We've seen in Europe, after record GDP growth in the third quarter, a second wave of COVID-19 resurging that has now raised the threat of a double-dip recession. And looking to China, after growth slumping 6.8% in the first quarter, it's now rebounded to 4.9% in Q3. And we have the IMF predicting that China will be the only G20 economy expected to show any growth this year. And as the world awaits the results of Tuesday's US presidential election, today's Belz Family China Insights session is extremely timely. Today, we have invited Mark Kruger from Yicai Global to speak about China's third quarter GDP outcome. Mark is Yicai Global's opinion editor and senior fellow to the Yicai Research Institute. Mark is also the senior fellow at both the University of Alberta's China Institute and the Centre for International Governance and Innovation. Mark began his career at the Alberta Petroleum Marketing Commission in Calgary and later joined the Royal Bank of Canada as an economist. He's held a number of positions at the bank, including Senior Policy Director in the bank's International Department. Mark has served as a Senior Advisor to the Canadian Executive Director at the IMF and was also head of the Economic and Financial Section at the Canadian Embassy in Beijing. So Mark will be giving us a deep dive into China's Q3 GDP figures, presented in the context of some other data points, and giving us a look forward to what it means for China's economic recovery. Mark will then be joined by Belz Family's managing partner, Gavin Ezekowitz, who will continue to unpack some of these themes, bringing it in the context of what it means to Australia and how we should be thinking about our trade and investment outlook. We will have time at the end for Q&As, so at any point in time, please feel free to ask your questions through the Q&A box below. So without further ado, over to you, Mark.
Thank you, Lucy. It's a real pleasure to be here. I really actually wish I was in Sydney or Melbourne, like two of the most beautiful cities I've ever visited. So maybe next year, after the disease has sort of subsided, we can do this in person. I'm going to go through some slides, lots of graphs and numbers, but don't worry. Almost everything I'm saying you can find in my opinion pieces on the Yicai Global website. So you don't have to worry about jotting down notes, no test at the end. We have a sort of glass half empty or glass half full situation here. A couple of weeks ago, the China's National Bureau of Statistics released the national accounts for the third quarter of 2020. And as Lucy said, growth was 4.9%. And that's a real big improvement over the 3.2 we saw in Q2. But still at almost 5%, we're a percentage point slower than growth overall of 2019. So in some sense, 4.9, is that really good because it's an improvement? Is the glass half full, or is the glass still half empty because we're still markedly lower than the speed that China could grow at? So what I have here is a graph of the contributions to GDP growth. It's the expenditure side of the national accounts. The green boxes here are consumption. The blue boxes are investment. And the red boxes are net exports. And these are the contributions, and they add up to the GDP numbers that we've been speaking about. You can see here the third quarter of 2020 was 4.9%. And if we're thinking about the dynamics of GDP over the year so far, really, the key is consumption. And you can see that the movements in GDP, the big decline in Q1, the recovery in Q2, the further recovery in Q3, that is really being driven by the pattern of consumption. You can see that consumption was actually, the contributions were actually negative in the first two quarters of the year. And in Q3, consumption contributed 1.7 percentage points to GDP growth. Now 1.7, it's not a bad number, but it's about half of what we saw in 2019. So really, again, the idea here is that if you want to know what's going on with GDP, you got to think about consumption. Now, if you want to know what's happening about consumption, you have to focus on the Chinese labor markets because, people are earning salaries, they're getting employment, and those are the big factors that are driving consumption. So when we think about the Chinese labor market, it's good to begin with the migrant workers. Why do we want to begin here? Because the migrant workers are what economists call the marginal worker. The migrant workers are very sensitive to economic conditions. They're the first to be let go in bad times and the first to be hired during booms. But here's a graph of the situation for the migrant workers. The blue line shows us the number of migrant workers in millions, and that's read off the left-hand axis. And the dotted red line shows wage growth, and that's read off the right-hand axis. And the number of migrant workers was down 1% from the third quarter last year, but the number of migrant workers is actually growing over time. So really the gap is about 2%. So the amount of migrant workers being hired in Q3 is about 2% less than normal, and their wage growth in Q3 was about 2% year over year. And that's much lower than, as you can see, than the 6 or 7% that they were earning in previous years. So fewer workers being hired, they're earning a lot less, they're earning lower wages. That is really going to weigh on consumption. Moving now to the formal market, the formal urban market. This year so far, we've created 9 million jobs, and that essentially meets the government's target, the government's target for formal job creation that they announced during the National People's Congress in May. So that's good, but last year they created 13.5 million jobs, and the target was 11 million, so they overshot the target. They'll probably overshoot again this year, but again, while meeting the target is certainly good, 9 million jobs is a lot less than 13.5 million. So here's a look at the monthly job creation. This is the amount of new jobs created in the formal urban labor market. The red line is 2020, and we have the past 3 years on this graph as well, 2019, 18, and 17 in the various shades of blue. And you can see that job creation so far this year was about 20% below what we have seen in previous years. But the worst is clearly behind us. You can see that that red line has come up, and it's now meeting in September the amount of job creation that we saw in previous years, about 1 million new jobs created in September. So we don't know where we're going to go from here, but it's likely, it's possible at least, that we could see a continuation of this trend, that job creation in the last quarter of the year could probably exceed what we had seen in previous years, and that would kind of suck up this excess labor, reduce the labor market gap, and help support consumption. So labor market has not yet recovered. It's recovered from its devastation in Q1, but it's really not it's not back to normal. There are still sizable labor market gaps, and real incomes in Q3 remain sluggish, and spending is depressed. So here's a graph that shows us three things. The red line here is the growth in real consumer expenditure year over year. The red line, the green line is is the growth in real disposable income, and the black line is the savings rate. So we see here that consumption is being hit by a double whammy. On the first hand, income growth, as you can see, is below trend. Income growth in Q3 was 4.4% year over year, and that compares to 6.5% over the last number of years. So income growth slower than trend, and this is income growth in real terms. We're subtracting the price effect. So income growth lower, that's going to hurt consumption. But then we see also that the savings rate ticked up so far this year. It's about 5 percentage points higher to the year to date than it has been in previous years. So you can see that in the past, expenditures and incomes have basically followed each other. The red line and the green line are pretty close. But this year they've decoupled, and that's because savings have increased. There's a lot of uncertainty among consumers of what's going to happen in the future, how the disease is going to play out, what the employment situation is going to be. And so people are tending to spend less than they have in previous years, even though their incomes have recovered to some extent. So that's kind of a quick look at Q3. How about Q4? We're in Q4 now. The first event in Q4 was the Golden Week celebrations that followed the October 1st National Day. And consumption was not especially strong during that holiday week. Tourist travel was only 80% of what we saw last year. Lots of restrictions on travel. I have 2 school-age daughters, and in fact, the school doesn't want us leaving Shanghai, so that certainly puts a damper on travel. The National Bureau of Statistics tells us that spending on retail and catering was only up 5% year over year in nominal terms. So if we take out, say, a couple percentage point for prices, that's a pretty weak spending increase. However, when we look at the momentum in the national accounts, we saw that economic activity accelerated really quite significantly in September, especially industrial value added was quite strong. So as I started off the presentation with a discussion of GDP growth from the expenditure side, here's a look at GDP growth from the production side. And what it is, it's an add up of industry, services, and agriculture, the 3 large sectors for production. And you can see that in September, there was quite a large increase, quite a big acceleration in the growth of the economy. Growth in September itself was about 6%. And that was driven by strong industrial production. And when we look towards the end of the year, we think it's possible that a 6% growth could be maintained for the last 3 months of the year. There'll probably be some gentle rotation out of industry and into services as the labor market comes back to normal. So we're thinking for October, November, December, perhaps 6% growth in each one of those months as well. That would give the that would actually complete the economy. If this projection comes to pass, then the output gap, the difference between potential and actual output, would narrow from 1% in Q3 to 0% at the end of the year. Growth for the year of the whole would be about 1.9%. And this is, as Lucy said earlier, this is kind of what the IMF is thinking. The governor of the People's Bank suggests that growth could be around 2% this year. So at least as we begin the quarter, an outlook of 1.9 seems to me to be quite reasonable. Here's a graph that shows us the level of GDP. The light gray line is what GDP might have been before the year started, what people were sort of projecting, perhaps 6% growth for the year as a whole. So you can see that gray line increasing at a steady 6% rhythm. But in the actual fact, we had that big economic contraction in Q1, recovery in Q2, further recovery in Q3. And so if we can grow at 6% per month for the last 3 months, we'll basically come back to the path that we might have sketched out at the beginning of the year. The recovery would be back to normal. And the main thing to think about is that even though growth for the year might only be 1.9%, that's an average of all the terrible things that happen in Q1 and Q2 as well. So really don't think about 1.9%. Think about by the end of the year, we're back to a trend of 6% growth. And that's really quite an achievement for the Chinese economy. Now, as Lucy said, the IMF has come out with its forecast. I'm giving you here the IMF's October update. So this is the most very recent forecast the IMF has made. I'm giving you the numbers for 2020, 2021, and then growth over both 2021, 2020, 2021. And you can see that over the 2-year period now, China is growing by over 10%, whereas the major economies elsewhere are contracting. The US by just over 1%, and the Euro area and Japan are contracting by 3%. So this shows that this terrible disease, which is taking a toll everywhere, is really accelerating a longer run trend. This is a graph of the relative size of the Chinese economy relative to that of the US economy at market exchange rates. And you can see that the disease is actually, China's relatively better outcome over this 2-year period is accelerating a 20-year trend. You can see that back in 2001, the Chinese economy was just over 10% the size of the US economy. By 2015, it was about 60% the size. Last year is about 2/3 the size. And if the IMF's forecast come to pass, by the end of 2021, the Chinese economy will be 75% the size of the US economy. So that's quite a lot of catch up in a short amount of time. So what does this mean? This means that China will be having exerting greater economic gravity. Economists think of economic gravity as being a function of the size of the economy. The larger the economy is, the more it attracts international trade and investment, and the greater pull it has over global markets. And there's a very important implication to that, is that the bigger the Chinese market gets, the more unlikely it is that global firms will leave China, especially if those firms are choosing to serve the Chinese market. And I guess I want to make a final point, is that the Chinese economy is quite successful compared to those of the other countries. And China is doing this recovery with less reliance on policy. China managed the virus well. It got people back to work fairly quickly. The economy benefits from 2 key buffers. Both households and corporates in China save a lot of money. Therefore, they don't have to exert a lot of debt when they recover. And also, the migrant workers provide a lot of flexibility to the labor market. So whereas in other countries, labor laid off had to be subsidized by the government, in China, basically the migrant workers go home and are taken care of by their families. So the implication here is that less support was needed in China than the other countries, and that China retains more policy space going forward. It's subject to fewer vulnerabilities. When the governments across the world loosen fiscal policy and loosen monetary policy, this gives rise to certain vulnerabilities, greater riskiness on the debt and higher inflation risks, and the chance of bubbles in the financial sector or in housing markets. So China is doing much better than the other countries in this regard. What China does, instead of sort of using fiscal policy to support consumption, is that it uses infrastructure investment. Infrastructure investment both acts as a demand management tool, it keeps people working, and it provides employment in times when private investment is weak. And so far this year, we've seen significant investments in power, natural gas, and water. So talking about the vulnerabilities, this is IMF data. These are IMF predictions for the end of this year on general government debt. The dark blue boxes are debt as at the end of last year, and we're adding on top of that the debt being incurred in 2020. And so you can see that by the end of this year, the IMF projects that government debt in China will be about half of what it is in the US and significantly lower than in the Euro area. So lower indebtedness means less risk. So you can imagine that more people will be comfortable buying Chinese government bonds because the relative default risks in China will now be significantly lower. And turning to the monetary side, what we have here is a graph of the index of the monetary base. So this is currency in circulation in the major economies. And what we see is that in the US and in the Eurozone, basically the amount of money in circulation is 40% higher than it was in January 2019. In China, there's a big seasonal effect here, but in China, the monetary base is only up 11% year over year. It's not really fair to compare it to January in China, but 11% year over year in China versus 40% in the euro area in the US. So the more money you put into circulation, the greater the chance of igniting bubbles in either the stock market or the housing market. So greater risk of that in both the euro area and in the US than we see in China. So let me conclude, and then happy to have a discussion with you all. Point one, the recovery is well underway in China. And, I think that we could be confident that it could be complete by year end. Also, China's recovery is less reliant on policy support than what we see elsewhere. That means China retains more policy space in case bad things happen in the future. And the Chinese economy, because it's not using up those fiscal buffers and monetary buffers, is subject to fewer vulnerabilities than we see in other countries. Finally, the COVID-19 is accelerating a 2-decade trend of economic convergence. China will continue to attract international trade and investment, and it will increase its pull over global markets. So for those of you that are interested in more insights on the Chinese economy, I welcome you to come to my opinion page on the Yicai Global website. The link is here and the QR code is there. Otherwise, easily found by Googling my name and Yicai Global. So that's my presentation, and I'm very happy to take your questions.
Okay. Excellent, Mark. Well, that's tremendous. Thank you so much.
Thank you very much. It was an excellent presentation, and I would like to invite Gavin now to join us to continue this conversation. And very briefly about Gavin. He has over 20 years of leadership roles that he's held in the capital markets division at the Royal Bank of Canada. And Gavin brings over more than 25 years of experience in global investment banking and capital markets across North America, Europe, and the Asia Pacific to the Belz family team. So back to you, Gavin and Mark.
Well, that's great. And thank you, Lucy. Thank you so much for joining us, Mark. And so it should be noted that one of the reasons I found Mark is that Mark is at the University of Alberta. I actually attended the University of Alberta myself. So when I found that there was a guy who I thought was actually based in Edmonton, turns out he's based in Shanghai, so much better. I thought I'd reach out to him, and he's turned out to be a great partner to us. And we're always happy to publish his pieces in our community and to have him on. So thank you so much, Mark. Appreciate your time. So let me begin with a high level question. And for as long as I can remember, everybody in markets had said the Chinese economic numbers are a fiction. They can't be trusted. Interestingly, and anyone who's reading The Economist would note that the Fed, the US Fed, has said that China's economic numbers are probably both overstated and understated, depending on the period. But I think what's curious for us is you've gone through a lot of statistics, and as an economist, having studied China for a long time, given this backdrop that the numbers may be slightly smoothed and massaged, how do you think about the figures coming from the government in terms of their utility for practitioners? How do you context them, given that there probably is some smoothing or some belief that there's smoothing going on?
Well, yeah, I think there are concerns about the statistics. I think that when you look at the package of statistics, there's more reliable and less reliable numbers. So, basically economic statistics can be divided into sort of two buckets. There's stuff that's counted. So for example, exports and imports are counted. There's some guy at customs sort of counting out the value and the volume of stuff that cross the borders. And we can sort of cross-check export numbers from China with import numbers from its trading partners. And people have done that work, and they find that they match pretty well because exports are counted. Other things like monetary numbers. These numbers are typically counted. The People's Bank's balance sheet is counting up all the currency in circulation. And this is probably a very reliable number. Other numbers are estimated. So for example, GDP itself is estimated. It's estimated in every single country, not just China, but in Canada and in Australia. The statisticians estimate what GDP could be. Now, the statisticians in China have a problem that the economy is huge and incredibly dynamic. So the estimation process is very difficult. is probably always one step ahead of where the statisticians could be. Even in our economies, we have a hard time thinking about like the digital economy and how to estimate that and what it means for GDP. Well, they have that in spades in China. So I think the way to approach the Chinese data is look at as many data sources as we can and try and triangulate them and see if they make sense. Some data sources are clearly not as reliable as others. So for example, the labor market information in China it's improving, but I think it's still one where we may not want to take the numbers at face value, and we can look at other ways of getting information about the Chinese labor market. Other information is probably, the trade numbers are probably pretty good, I think. So what we do is we look at a series of high frequency indicators. We have articles about that on our website. These are indicators that are not put out by the government, and we sort of correlate them with the numbers given by the government. We find they match fairly well, not exactly, but they match fairly well. So I think the broad trend in the economy that I just presented, a sharp slowdown in Q1, a very rapid recovery in Q2, and a somewhat more subdued recovery in Q3. I think that's definitely what's going on, although we could quibble about the decimal points.
Right. No, okay, very nicely put. And you touched on the labor market, both in your presentation and in your comments. It looks to me like there's been a significant rebound in both manufacturing and services, but particularly in manufacturing. But it doesn't seem like the data is quite yet catching up in terms of employment and wages. What is going on? Is there a lag effect? Is that a data effect? What's your view there?
Well, I think like as you say, it's kind of a two-speed economy with manufacturing faster and services slower. Services are more labor intensive, right? So, so let's just step back a bit. Why is manufacturing doing so well? Because it's based not only on China's internal demand, but also on external demand. We know exports are doing very well. China has recovered much more rapidly than its trading partners, and so it's gaining market share. Other factories elsewhere in the world are just not up and running to the extent that the Chinese factories are. So they're able to supply a lot of manufactured goods, not only to their own market, which is the major source, of course, but also to export markets. So the factories are up and running. That calls for people, but it calls for also a lot of machinery and other things. In the service area, when you think about, for example, restaurant spending at restaurants is still way down. Many people are still concerned about disease, and they hesitate to go out for a meal. Well, a restaurant is a very labor-intensive operation. You have cooks and waiters and door people and whatever. And so that's because of the service manufacturing split of the economy. That is why I think the labor market is lagging the economy as a whole. But I do think that people are becoming more confident. There really hasn't been a serious outbreak of COVID-19 in China for a while. There was something in Qingdao not so long ago, but they seem to have put a lid on that. When there is an outbreak, the government acts very quickly to test and to isolate. And so I'm thinking that, over time, people become more confident again. We will see people going out and consuming restaurant services, travel services. Travel is well done. Domestic and foreign travel, very down very sharply in China. But I think that over time that will increase, and the labor markets should come back to control.
Right. No, good point. So let's shift a little bit to consumption, obviously somewhat related to the labor market. It seems a key argument in your article is that the rebound in Chinese consumption is in part related to the way that consumption incorporates government spending as well. But if we look at consumer consumption, we have this debate in the West as well, which is potentially there's a lot of pent-up demand in the consumer. Savings rates have increased. That could be money that's set aside now to get spending once people get more confident. On the contrary, there's a risk that the consumer doesn't find its feet and the government continues to spend. Where do you find you come out? Do you think that the consumer is about ready to emerge, perhaps going into Chinese New Year? What hangs in the balance here as you think about it?
Well, I mean, what we see in consumption is, again, it's consumption of services that are really lagging, especially, like I say, travel, restaurant, hotel, these sorts of services. This is what's lagging because again, it's the people-to-people contact that that worries people. If we look at things like automobiles, they're very strong. So that's actually quite encouraging. You don't buy a car if you think you're going to lose your job. You might lose your job in the future. You're going to keep that old car a little bit longer. So when we see strong purchases of consumer durables like cars, that's a very favorable sign. We're also seeing a pretty good pickup in the housing market. Housing sales are good. Again, you probably would not go out and stop renting and go buy a house today if you thought your job was in danger. So it's really a lot of compositional shift in the labor market, in the consumption basket. People buying consumer durables, but not spending on services. Right. So, like you said, savings rates are high. There is pent-up demand, and I think that over time, as people become confident, we will see a resumption in the old spending patterns. The thing is, though, that if you were going to go on a holiday, let's say a one-week holiday every quarter, you can't go back and retake the holiday that you might have taken in Q1. That's kind of gone forever, right? You probably won't take an extra week next year. So that's gone forever. We won't see that come back. But I do think that over time, as people become more confident, we will see a greater consumption of services.
Right. Okay. Well, let's maybe start looking forward a little bit, talk a little bit about Q4. Obviously, you make a compelling argument about Q4 GDP and, in fact, 2021 growth, which points in a different direction than what we're seeing in much of the West, where recovery is in large part going to be delayed and best into the latter part of 2021. But now thinking a little bit about Q4, we're in Q4. We don't want to wait until the government data comes out. So maybe you can help us a little bit and tell us, what are some of those higher frequency indicators that you would be watching for as we're traveling through this period to know that we're on track and that we're going to continue to see robust growth to that 6% type run rate?
Right. Well, the key monthly indicators are industrial value added and the index of service production. Basically, if you just wait and add up those two indicators, you get a pretty good picture of what's going on in GDP. Those data are released about 2 weeks after the end of the month. So we'll only get October data in a couple of weeks. Aside from that, there's all kinds of daily information. There's information on apartment purchases. There's information on subway ridership. There's information on a number of different prices. So again, we have a high frequency index that we track regularly. We publish articles on that, and I think that that's also going to give us a great indication of how things are coming up in the nearer term. But I again, as you mentioned, the other economies are doing poorly. That is not good for China, right? In some sense, they need foreign demand to pick up. They're getting some market share here. But again, it'd be great if the rest of the world could recover just a little bit more quickly.
Right. So, it's interesting. So we're talking a little bit about recovery, we're talking about consumption. There's a question that's come in, and I think relates a little bit to data and a little bit to path of recovery and confidence. As we sit here in the US or Australia, we've got this constant deluge of reporting on COVID cases. And one of the, I think, suspicions that sits for many investors is that China is underreporting its COVID cases. Do you find, as you sit in China today, that the facts on the ground, if you will, are that whether or not these cases are perfectly aligned, broadly, China is probably in about the same place somewhere like Australia is, with tens of cases in different places versus thousands or some sort of a broader pandemic. And I guess the way it would play out is that are consumers nervous for other reasons? They're not nervous because COVID is more prevalent. Does that make sense, Mark?
I think that the government has no incentive to hide COVID cases. As we saw in Qingdao, I think there were like a dozen or so cases, and the government moved to test a city of 9 million people over 5 days, right? So 12 cases, you could probably hide those, but there's no incentive for them to do that. They don't want the disease to spread, right? And I think that, in this era of social media and whatnot, it's hard to hide it, right? All you got to do is say, my cousin has COVID or something else, or, I find out there's just no incentive. So, I think that perhaps at the very beginning, with respect to Wuhan, maybe those numbers are, I have no idea what the numbers were, but you could imagine that it was very hard to verify how many people got sick. But I think that now, there's checks everywhere. People take my temperature going in and out of all these places. And I think that schools are very careful as well. I have 2 school-age kids, and we have to give our health check, our health QR cards, to the school every day. And so there's just no incentive to not report COVID when it comes out, right? So I don't know. I think that actually China's in quite a good place, right? And I also think that, when we look what's going on in the UK, they're just locking down the whole country again. We never had total lockdown here. We only had lockdowns of the affected places. Here in Shanghai, I was free to go anywhere and do anything. I had to wear a mask, which was fine. Everybody wore a mask. People took my temperature all the time, which was also okay, even coming and going. But I think they've just done an awesome job of shutting this thing down. We had something like 7 deaths in Shanghai. That's a city of 24 million people, 7 deaths, right? Even if it's 70, even if it's 700,
Right.
What a great achievement.
Yeah. No, I think it's an interesting point. I think it's the most difficult for my friends in the U.S. to understand, given that it's really an unconstrained disease at the moment. For those of us in Australia, of course, we're incredibly fortunate. I think Australia's done a pretty good job as well. So I know, good to hear your context there, Mark.
I would also say that, Gavin,
Yeah.
sorry, I'd also just like to say that I think mask wearing is just a huge, huge thing here, right? And that really helps. And it took even the WHO until like mid-year was saying, oh, you ought not to wear a mask unless you're sick, right? And here, from the get-go, even before the government really said anything, people wore masks. It was just normal. And, it's just logical that if you're sick, you should be wearing them. And even if you're not, and the thing is, you don't know who's sick, right?
Yeah.
So it's like a positive sum game. If we all wear masks, we don't have to worry about who's sick and who's not. We're just all going to do that. And that's what they did here from the very beginning, even before it was made mandatory. And then when it was made mandatory, there was no pushback like we see in other countries. Oh, it's an infringement. It's not an infringement. You're infecting the air around me. It's an externality. Anyway, I just want to say that I believe that mask wearing was a big factor in controlling the disease, not only in China, but also in Japan and Korea, where infection rates are much lower than what we see in the West.
Right, and in Canada, by the way, my brother who's in Alberta would tell you that their caution has paid off in that regard as well. So let's turn back a little bit to Australia and some of the implications for Australia. So we've obviously had a very different trade environment over the last few years. We've got a challenging economic environment globally. But for those of us sitting outside of China who are interacting with that economy, is there anything that might concern us, given that we're largely export-driven economies that are looking to access an economy whose sort of stated policy now is we want a domestically driven economy? Is there anything that sort of springs to mind as things to watch or things to be concerned about, or perhaps even better, opportunities for us in Australia?
Well, the Chinese economy was always domestically driven. Exports are important, but every economy, except for perhaps very small economies, are domestically driven, and it's always been a huge domestic economy here. But of course, there's this notion of comparative advantage. The Chinese can't do everything themselves, and other countries have economies that are complementary to those of China. So China has an economy that is abundant in people but low in resources, right? So I still think that countries like Australia and Canada have an amazing opportunity when you think about where China is going forward in terms of its resource needs, both in terms of primary materials and energy, and also in terms of foodstuffs, right? On foodstuffs, you know, the Chinese people are drinking more milk and eating more meat, but they just simply cannot grow that at home. They have to import it. And so I think that, you know, what countries like Canada and Australia want is a stable, growing China, right? And that will generate import opportunities. And like I said, our economies are complementary to those. We have economies that are abundant in land, but short in people, right? And so our comparative advantage is just the opposite, just a mirror image of China's. And so there's just, I think, countless opportunities.
Right, right. No, we'd agree, and we're hopeful that sort of recent trade disruption gets resolved quickly. Certainly for those of us who are day to day in that environment, it's unhelpful. It's unhelpful for our Chinese partners. It's unhelpful for those, you know, us in Australia as well. So I'm not going to ask you to comment on equity markets. I've been a big bull on Chinese equities all this year, and beginning to see on a relative basis that in fact Chinese equities are outperforming even a pretty excited global equity market. But when you step back and you look at sort of capital flows into the Chinese economy, do you see continued supportive drivers for equity markets, or do you see some clouds on the horizon? It would seem to me that shifting capital from real estate to business growth is a positive from a macro perspective. But that's perhaps how I understand it. I'd love to know how you understand it.
Right. So I think there's a huge shift going on in China. One of the biggest vulnerabilities that Chinese corporates face is their high levels of indebtedness. And the reason that they have high levels of indebtedness is that they're raising all their financing through bank loans. And that was fine for some period of time, but now it's come to a point where their debt equity ratios are very, very high, and the government's worried about that. The problem is that for many years, access to the equity market has been restricted. It's not an approval system like we have in the West. It's an administrative system. You sort of queue up, and the regulator will decide when you get to go IPO. But now the regulators are understanding that raising equity is a great alternative to raising bank loans as a source of finance, because you just don't have that leverage risk. And so what we're beginning to see is a movement towards approval-based financing. Disclosure-based financing. So the new STAR market in Shanghai and the Chinex market, these sort of innovation boards are not approval-based. They're just, the companies just go and present their information to an underwriter. They don't wait for approval, or approvals are super quick, and they're out raising funds. So we're going to see a lot more capital being raised in Chinese equity markets than ever before, and by a much broader set of companies. So, basically it's just been large industrial firms and some service-oriented firms, of course, raising capital. We're going to see a lot more small firms raising capital in the Chinese markets, in the Chinese equity markets. And so it's going to be a real boom. And as well, we're seeing Chinese equities and bonds being included in global indices. And this will drive a lot of passive investors to invest in the Chinese market. And the Chinese authorities are, of course, happy about this, because they want to share the risks involved in their capital markets with the rest of the world, right? Well, they don't want to keep all the risk themselves. They want to offload it to the rest of the world. And of course, because as I said earlier, Australia and Canada on the one hand and China on the other are complementary economies. So if you think of the global cycle, we should be at other ends of that global cycle. So when commodity prices are really high, it's good for our equity markets, but it's bad for China, and vice versa, right? So it's good if we share risks across the equity market, right? And this will happen more and more. The Chinese government is liberalizing access to its financial markets, and we're seeing, I think, that the foreign investors are being more and more attracted by those markets, and that's driven also in part by monetary policy in the Western world, right? These ultra low interest rates, there's a search for yield going up. And we're seeing that also, as I pointed out earlier, the Chinese government relatively becoming more creditworthy as its debt is growing much more slowly than the US. So I think all those factors mean that it will be quite buoyant for the equity markets going forward.
Right. No, good, great explanation. And I think that point around debt and the shift to equity preference is important, as is the shift to IPO markets and equity capital and shifting risk, shifting sophistication. I think there's a lot going on there. It's certainly something we're very involved in. A question that's perhaps a little bit outside of your area of expertise, but perhaps you have a perspective. Wanted to focus a little bit on the trade war and your thoughts on the impact of the trade war between China and the US and Australia. Do you, sitting as an economist, looking at the macro, what do you see in terms of the long-term issues, impacts, perhaps resolutions in terms of the trade dynamic that we see emerging over the last few years between the West and China?
Well, I think the trade war is a lose-lose proposition. The economists talk about something called a deadweight loss. When you impose trade restrictions, it makes everybody worse off. It makes you worse off, and it makes your trading partner worse off. And, I know at least from the US perspective, the US corporate sector is very unhappy with the tariffs that the current administration has imposed. In fact, thousands of US companies are actually suing the US government because of the damages that those tariffs have imposed on them. So I'm hoping that starting tomorrow, we see a big change. I think a lot of this trade stuff is politically driven. I don't even think, as I said, I don't even think from the US point of view, it's good for their own economy. I think that cooler heads will prevail. I'm thinking that we could see a change starting tomorrow with the election that will ripple across the world. And if you think about it, China, the US, the other economies like Australia and Canada, we got to all work together. We got big problems ahead of us in terms of climate and whatnot, and containing disease. And this kind of confrontational attitude that we have now is just totally counterproductive. And we got to find a way to put the rhetoric behind us and to work together to make this a better planet for everybody to live on.
Right. No, I think a good thematic. And look, I mean, we're running up against time, Lucy. I'm conscious of time. Mark, it's been an absolute pleasure chatting with you. I want to bring you back. I want to talk about the digital renminbi, because I think that's one of the most important developments globally as well. We could go on for hours, but maybe I'll turn it back over to you, Lucy. Thank you, Mark, so much, and we'll look forward to talking to you another time.
Thanks, Gavin.
Thank you. Thank you very much, everybody. And thank you, Mark and Gavin, for an incredibly insightful session today. Today's session has been recorded, and so we will be sending around a replay, which we do encourage you to share with your community. Today's session is also part of our mission to build a collaborative community of Chinese and Australian family offices, sophisticated investors and their advisors, to provide the opportunity to learn from one another and to provide a platform to allow us to create this long-term collaboration, investment and partnership opportunities that we've been talking about. We always love to hear from you and get your feedback on how we can better help you and our community through events like this or others. So thank you very much again, Mark, for your time. As Gavin has said, we would love to have you back to talk about some other very pressing and interesting issues. And for everyone else who has joined us, have a great rest of your Monday.